Good morning and welcome to TOITOI Japan Market Radio for Wednesday, February 4, 2026. I'm your host coming to you from Tokyo, and this is your daily briefing on Japanese markets for global investors tracking Japan exposure. We've got a packed session today with some conflicting headlines on Japanese equities, so let's dive straight in. Joining me as always is our portfolio manager who focuses on Japan macro. Can you give us the big picture on where markets closed today?
Absolutely, happy to be here. So we're seeing a bit of a mixed picture in Japanese equities today. The Nikkei 225 ended at 54,293.359, down 0.781% on the session. Meanwhile, the TOPIX actually posted a slight gain, finishing at 3838.0, up 0.183%. So you've got a divergence there between the two major indices. The Mothers Index, which tracks smaller growth names, fell 0.539% to 2215.0. On a brighter note, J-REITs showed some strength, up 0.713% to 2048.0. Over in currency markets, dollar-yen is trading at 156.633, which represents a 0.766% move higher for the dollar. And notably, gold priced in yen surged 4.199% to 18,735.0, while crude oil ticked up just 0.411% to 63.47.
That gold move in yen terms is quite striking. Now, I want to turn to what's creating some confusion in the headlines today. We're seeing reports that the Nikkei 225 has retreated from an all-time high, yet there's also coverage of a major surge led by Sumitomo Electric. Can you help us make sense of what's actually happening here?
Yes, this is a good example of why investors need to look beyond the headlines. What we're seeing is conflicting snapshots from different timeframes. The retreat from all-time highs appears to be the broader context, a pullback after the Nikkei had been making record levels through late 2025 and into early 2026. The market has essentially taken profits after a sustained rally, which is actually fairly healthy behavior. What matters for Japan specifically is whether this is just consolidation or the start of something deeper. We need to watch key support levels closely.
And what does this pullback signal about investor sentiment toward Japanese equities more broadly?
There are a few factors to consider. First, valuations had stretched relative to fundamentals after that long rally, so some correction was almost inevitable. Second, we may be seeing a reassessment of corporate earnings expectations, particularly if global growth concerns are creeping in. Third, there could be shifts in positioning, both domestic Japanese investors and foreign allocators potentially taking chips off the table. For the Nikkei and TOPIX, the key question is whether we see follow-through selling or if buyers step in at these levels.
How should this equity weakness play into the yen and JGB dynamics?
Classically, risk-off sentiment in equities tends to support the yen as a safe haven currency. If we see a broader market retreat develop, that could put downward pressure on dollar-yen, meaning yen appreciation. On the rate side, equity weakness often correlates with lower yields as investors seek the safety of government bonds. So we might see a bid for JGBs, which would push the 10-year yield lower. That said, the effect depends on whether this is purely a Japan story or part of a global risk-off move.
Staying with the equity theme, let's talk about the Sumitomo Electric story that's also making headlines. We saw reports of the Nikkei surging 3.92% with Sumitomo Electric leading with a gain of 12.51%. How does this fit with the pullback narrative?
This appears to be referencing a prior session, likely the strong day that contributed to the all-time high before the retreat. What's important here is that Sumitomo Electric is a major Nikkei component and a bellwether for Japan's industrial and infrastructure sectors. A double-digit gain like 12.51% in a blue-chip name of that caliber doesn't happen in a vacuum. It typically signals either very strong company-specific catalysts, such as better-than-expected earnings, positive guidance, or major contract wins, or it reflects renewed investor appetite for Japanese industrial equities more broadly.
What does strength in a name like Sumitomo Electric tell us about Japan's competitive positioning?
It's actually quite encouraging for Japan's manufacturing and export story. Sumitomo Electric operates across automotive components, infrastructure cable systems, and electronics materials, all areas where Japan maintains technological leadership. Strong performance there suggests growing confidence in Japan's industrial competitiveness, particularly as global supply chains continue to reconfigure. A 3.92% rally in the Nikkei, if that was the session in question, would represent substantial momentum and could indicate rotation into cyclical and industrial stocks.
And how would that kind of risk-on move flow through to currency and rates?
Risk-on sentiment in equities typically has mixed effects on the yen. If the rally is driven by domestic Japanese investors moving from cash into stocks, you might actually see some yen strength as funds are repatriated. But if it's driven by foreign inflows chasing Japanese equities, that would likely put upward pressure on dollar-yen as investors sell yen to buy stocks. On JGB yields, equity market strength can lift the long end modestly as investors rotate out of bonds into stocks, though that effect tends to be muted given Japan's overall macro conditions and BOJ policy stance.
Shifting to some international news with Japan implications, Texas Instruments announced a $7.5 billion acquisition of Silicon Laboratories. This is a major consolidation play in the chip design space. Why should Japan investors care about a deal between two U.S. semiconductor companies?
This deal matters for Japan because it further concentrates chip design capabilities among non-Japanese players, and that has real implications. Texas Instruments is combining its analog and embedded processing expertise with Silicon Labs' mixed-signal semiconductor capabilities. For Japanese electronics manufacturers, this means potentially fewer independent suppliers and reduced diversification in global semiconductor sourcing, which is already a key concern. Japanese chipmakers like Renesas, Sony's semiconductor division, and ROHM are facing intensified competition from larger, better capitalized U.S. designers.
How does this kind of consolidation affect the competitive landscape for Japan's semiconductor sector?
It creates headwinds, frankly. This M&A activity signals continued U.S. industry consolidation that may pressure margins across the entire sector. Japanese mid-cap chipmakers that lack scale are particularly vulnerable. For Japanese OEMs that rely on third-party chip designs, they may face higher costs, longer lead times, or fewer negotiating options. In terms of market impact, I'd expect modest negative pressure on semiconductor and electronics stocks in the Nikkei and TOPIX. Consolidation among suppliers typically disadvantages smaller competitors who can't match the combined R&D budgets and economies of scale.
Any read-through to the yen or JGB yields from this type of corporate deal?
Minimal direct impact on currency. Any yen weakness would be quite marginal and sector-specific. On JGBs, this is really a corporate event with no macroeconomic implications for Japanese rates. The impact is primarily on individual stock valuations in the semiconductor supply chain. But thematically, it does reinforce that Japanese tech companies are operating in an increasingly consolidated global landscape, which is something long-term Japan allocators need to factor into their sector positioning.
As we wrap up today's session, what are the key themes global investors should be taking away from today's Japan markets?
I think there are three main points. First, Japanese equities are in a consolidation phase after reaching all-time highs, and whether this is healthy profit-taking or something more significant will depend on the next few sessions. Second, we're seeing pockets of real strength in Japanese industrials, which suggests underlying confidence in Japan's export competitiveness even amid the broader pullback. And third, global semiconductor consolidation continues to present challenges for mid-tier Japanese chipmakers, which is a structural headwind that investors in that sector need to monitor closely.
And on the currency and rates front, what should people be watching?
Dollar-yen remains sensitive to risk sentiment, so watch whether equity weakness translates into safe haven yen demand. We're currently at 156.633, and a move below 156 would be worth noting. On JGBs, any sustained equity weakness should put a bid under government bonds, though the BOJ's policy framework continues to be the dominant driver of the curve. The interplay between domestic risk sentiment and global factors will be key in the sessions ahead.
Excellent overview as always. That's all we have time for today on TOITOI Japan Market Radio. If you're a global investor tracking Japan exposure, this is your daily briefing on what matters in Tokyo markets. Consider subscribing if you want to stay on top of Japanese equities, currency, and rates. We'll be back tomorrow with another full market update. Thanks for listening.